In this video, I'm going to be teaching you my personal favorite strategy for mitigating your losses in trading by maximizing your profits by 2 to 3 fold. I'm sure a lot of you have heard the saying to let your winners ride, but what does this actually mean? And why do so many traders diminish their profit potential by scaling out of their winning trades? You may take 10% here, 20% here, 50% here, ultimately reducing the overall potential on the trade. This is where majority of traders are failing. They're scaling out of their winning trades, all the while scaling in to their losing trades. Now we know if we're at the point of executing a trade, we've developed a thesis, we have a plan, we know where we're going to take profits, we know where our invalidation is and where we're going to stop out if the trade goes against us. So why do we consistently go against our plan? Why don't we trust our plan and let it play out the way it needs to? I'm going to be teaching you how to double or triple your profit on a trade, all the while keeping your risk low. So let's get into it. It's important to note that this strategy should be done primarily in trending markets. What I'm going to be showing you is how to compound on your winning trades and increase your maximum profit potential while keeping your risk low. We do this by shifting our mind frame a little bit. Instead of taking profits along the way up and reducing your overall profit at the end target point, we're going to be adding on to our trade as the trade progresses. So I'm going to give you an example on two of the trades that I took yesterday and how I executed these trades. Just yesterday, I was trading this Sushi USD perpetual contract. And what happened is we broke through a key level of support. The price action was appearing to be printing a rising wedge. Okay, these patterns do have a higher probable chance of breaking to the downside. So I waited for my confirmation and I entered short on the break of market structure and the bottom of the trend line. Okay, I had an overall take profit target at this weekly level down here around about $1.14, and my stop loss was just above the pattern, yielding a 3.7R trade. Okay, so there are two ways I could have managed this trade, right? Ultimately, I could have taken profits here at the first level of support, or I could have waited until that level was taken out and then added on to my position, okay? Doubling my position size, so by the time I got to my target, it was doubling my profit size. One of the most important parts about trade compounding is that you have to wait until the trade moves a certain distance away and until you can put your stop loss at break even. So you need to wait until it actually makes sense for you to put your stop loss at break even. And when you put on your second trade, you place the stop loss for that trade at where you entered on the first trade. This is the most important part about adding on to your winners. You always have to put your initial trade at break even. So if you are using the same position size, you are not taking in any more risk by doubling your position size. Okay, so you can see as I entered here on the break of this support level, my new stop loss was placed at the exact same point that I entered on the first trade. And I took the exact same position size, so I'm not taking on any more risk. At the end of the day, this all comes down to trade management, and there are multiple ways you can execute these types of trades. You can wait until very important areas of support or resistance are taken out, or you can wait until a pattern has emerged and you can trade that additional pattern. So you're constantly finding new setups to take to add on to your original setup. These are best done in trending markets when you're looking for a swing trade. Sometimes you can compound 3, 4, or even 5 times. And usually by the time you compound on the third trade, your entry point is higher than your initial break-even point. So either way, you'll be locking in profits. Another important thing to note is that because you are adding on to your trade, you are also adding on to your average entry price. So for example, as you can see here, my first entry was at $1.23, and my second entry was down here at about $1.20 in this zone here. So what happened is my average entry increased to $1.21. This point here would have been my break-even point. So if I wanted my overall trade to be break-even, I would have placed my stop loss at that entry price. I was still happy taking on a little bit of risk though, so I kept my stop loss at the first trade's break-even. How many trades you win and how many trades you lose don't necessarily matter when it comes to making money as a trader. The most important part about making money as a trader is your trade expectancy. You could have a 40, 50, 60% win rate and still make money. You just need to know how to scale in, really take advantage of your winning trades and maximizing your profits and cutting your losers quick. I also took a trade on HNT. I'll show you that one as well. It is a little bit more complicated and I did compound 3 times, but I'll give you an example of how I did it on this one. So I noticed here we were grinding against this bottom trend line. Okay, so I shorted the bear flag here as soon as it broke out, and then we got down to our next level of support in which we broke that too. So I entered again, putting my stop loss at break even on the first trade. Then we consolidated for a little bit during here, putting in a little bit of a consolidation phase. I marketed in on the break of this range, putting my stop loss in profits. So as the trade progressed, we broke down from the consolidation range and I took my profit somewhere down here at about $4.07. I think it was a little bit higher actually. I probably got filled somewhere about here. Okay. So essentially this is compounding onto your trades. It is a great way to turn a 3-4R trade into a 6-7-8R trade if done correctly. It is a great way to mitigate your losses in trading. You can make back more from one good trade than you lost in 8 trades. And this comes down to letting your winners ride. So I hope you like this lesson and I hope you put this strategy into practice.